You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, welcome back, everybody. Welcome back, Brandon. How are you doing? We're
hello, friend.
What are we? 2 weeks away from the end of the year.
It's crunch time. I think we mentioned this last week, didn't we? But I mean, I'm leaving for Adelaide in 4 days, and then I'm not back until like the 27th or 28th. So I've got here we go, 4 days to make, I think, like 3 or 4 videos or something crazy. It is crunch time. It is crunch time.
Good luck to you, sir. I've got a little bit more time. I'm going to take off from the end of next week, so I'm only taking a week and a little bit off. So, you've got a bit of a cram, and included in that cram is a little bit of a cram in terms of the podcast. We're going to take a week off, so we're going to try and pre-record another episode. I guess we'll kind of see how we go next week anyway. Maybe see how you go for the next 4 days. But we may very well be doing a Q&A special podcast for that week that we're off. So I thought I'd mention immediately, just so that everyone is aware, if you have a question that you want to ask us, it can be investing related, it can be related to us on YouTube, us personally, whatever it is, we'll take it. We might not answer it, but we'll take it.
We'll take it.
We'll take all your questions, whatever you've got.
Yeah.
And leave them as a comment on the latest episode on the YouTube version of the podcast, and we'll consolidate them all, and we'll try and do a big episode where we answer everyone's questions.
Yeah,
so
just bang, bang, bang. Yeah, I think if all goes well, we'll still be doing our regular podcast next week, the Christmas episode, and then it will probably be the one that comes. It'll be the New Year's episode that will be probably a Q&A special. But I mean, to be honest, people probably don't want to cure their 1st of January hangovers by listening to in-depth kind of financial news and stuff. They probably want something a bit more relaxed, you know?
Yeah, it works out well. Maybe we can pre-record it and we can pretend that we're hungover as well, so that, you know, we get the we kind of fit in with the vibe of everyone else, you know?
I don't know how you're feeling, but I'm not feeling great.
Really don't want to do this podcast today, Brandon.
Oh, my head. Oh dear.
No, but we've got an exciting episode today. There's a
lot to talk about.
Oh my God, there's so much to talk about. There's an update on the debt ceiling drama. Remember last week we spoke about how they were going to run out of time yesterday as we're recording this, and a few days ago as you're listening to this. So what happened? We'll talk about that. There's some news around inflation, some news around what the Fed has been doing in response to inflation, and a couple other stories. One about Elon Musk, Time Person of the Year. So
a
few things to talk about. But let's just get straight into it. Today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So basically, you can bring in all of your trades either automatically by connecting your broker to Sharesight or manually by using Excel or just manually entering in every single trade. And once you do that, it will track all of the different types of gains that you experience in your portfolio. So capital gains, dividends, if you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, and you can track up to 10 holdings for as long as you want. Or you can also use that link to sign up to a paid plan for more features, more reporting, that sort of thing.
4 months free.
And you get 4 months free. Wow.
Woo-hoo.
Just, God. Thanks, Brandon. Take it away.
Stole your thunder.
It's my favorite part.
Yeah.
4 months off a yearly subscription. So
it is pretty good. It is actually, like, there's not too many I don't know, subscription services where some sort of deal would give you like 4 months free. It's pretty decent.
That is a pretty good deal.
But yes, thank you to Sharesight, as always, for sponsoring the podcast. We appreciate it.
Yes. Do you want to? Where should we start today?
Maybe my gosh!
Should we start with inflation and the Fed? I think we should start there because.
Sure.
The inflation numbers came out about 5 days ago from recording this, so about a week ago, really, from when you're listening to this. But they are crazy, and we have to talk about it. So last month, we spoke about inflation. It hit 6.2%, I think it was.
Yeah, it was.
And that was a year-over-year figure, 6.2%, which was the highest increase since 1990, I believe it was. So 31 years, which is crazy. And we spoke about how insane that really was. It was a massive jump up from the last month as well. The month-over-month increase was 0.9%. So, I kind of, we never really know what's going to happen with inflation, but I certainly didn't expect another huge jump this month, I don't think. So this month, a few days ago, we got the latest data. Year-over-year inflation is now 6.8%, which is pretty insane.
Pretty much, wow, almost 7%.
Yeah, just shy of 7%. That's that really is something. It's the highest rate. This is the headline that you're seeing everywhere. It's the highest rate since 1982. But the ridiculous thing is that CNBC and all of these other news organizations, they compare inflation to 1982, but you actually can't even do that because they measure inflation completely differently.
You made a video on this, didn't you?
I did. I made a video talking about this, and really my video was inspired by Stephen Spicer's video, he did a deep dive investigation into this. So I'd recommend you check his video out if you want a real deep understanding on this. But yeah, all these news outlets compare the two metrics. You can't even compare them. If you actually use the same measurements as 1982 when they're drawing these comparisons saying, oh, inflation is the highest since 40 years ago. Inflation today using the same metrics is actually over 15%.
Wow.
Which is not just in line with 82, it's far above it. And it's actually the highest point. It matches the highest point in the 1970, 1980s inflation crisis. So it's really high.
How have they changed it?
So there's a number of ways that they kind of changed how they approach different things. One of the biggest ones was in terms of shelter, in terms of housing. So what they used to do is they used to simply take real measurements of increases such as increases in rent, right? So year-over-year increases in rent on average over different states in the United States, for example.
Makes sense.
What they do now is they still do that for renters, but they also do something called homeowner rental equivalency, which is where they call up and survey homeowners and they just ask them, hey, if you were renting this property out, what could you rent it out for? And they literally do that. And the idea behind it is so that they can get a gauge on how much increases would be for homeowners if they were renting out their properties. But it's kind of insane because I think Stephen Spicer spoke about in his video that I think last month the year-over-year increase in shelter was like 3.5% or something like that. But if you strictly took increases in rent in the United States, I think he was looking at a number of different states and the lowest one he could find was 10%. So they were all above 10%. But we're getting this much lower figure in the inflation numbers because we're using surveys.
So So long story short, it's like the two kind of measures of inflation, which are generally either the consumer price index or the personal consumption expenditures index. So that each one of those tracks like hundreds of different categories, right? And so you're just saying that versus way back then, the categories that get tracked to make up those numbers have changed quite substantially in some areas, and that makes it like a not comparable number.
Yeah, and I think housing and shelter, they call it shelter in the numbers. That's the most significant one because I think it accounts for about 30% of the overall CPI data. Compare the two metrics, you can't even, it's really expensive. So that's a big part of the data, and it is significantly skewed by this new approach, which to me doesn't really make a lot of sense. I mean, in my view, if you want to get an idea of what homeowners could be renting their properties out for, wouldn't you just take an average of real rent increases around that area and then assume that it would be fairly similar? Like if one person has a rental increase of 5% and next door is owner occupied, you could just assume that theirs would probably also have gone up at a similar rate. But I don't know.
And if you just call people and ask them what they would charge for rent, they're always going to like say a number that's higher than reality.
Well, I mean, a lot of people just wouldn't know, I think, as well. I mean, some
That's
people
true.
may never have been a home. They may never have rented in that area. They may never have owned an investment property. They may just live in a home that they purchased. And that's it.
Grandma's like, well, back in my day, I used to work for $15 a week, so I probably wouldn't want to charge any more than $5 a week.
I mean, you make that point, but it's actually true. I mean, if you imagine yourself as a young person renting maybe, and then you go and buy a house and you live in it for 20 years, and you hadn't thought about renting ever since then. You don't have an investment property or anything like that. Your idea of what you could rent your property out for would be warped to the downside, which would limit the inflation figure, which is exactly what happens. So it's kind of it's kind of strange. That's just one example of how it's kind of impacted in that way. But and that's not to say that the old method in the 80s was perfect. It wasn't. There's reasons why they changed it. But if you're doing a comparison, apples to apples, then we're at over 15%, and we're actually higher than we were back then. So
that's insane.
Rather than now it looks like we're at about 7% and you look back and they still had the heights of, 15, 16, 17% inflation. So it looks a lot lower than it is if you're comparing two numbers that can't really be compared. So kind of crazy.
That's crazy.
Yeah. And so month over month increase for the latest data was 0.8%. It was the second highest this year, only after last month, of course. And I thought, since this was the final reading of the year, we're going to get another one in January that'll give us, over December. But the final reading for the year, I thought we could look back on how good the Fed has been at projecting inflation this year. I thought it would be fun. We'll do a year in review. We'll do a Spotify Wrapped for Jerome Powell's ability to.
This is actually going to be interesting.
Inflation Wrapped. All right, so. So all the way back, so I'll give you what the number was for inflation and then the constant updates for projections from the Fed of what 2021 inflation would be. So basically we know 2021 inflation is about 6.8%, right? Because we're not quite at the end of the year, but we're pretty much
close
there,
enough.
right? So close enough.
Yeah.
But back in January of this year over year inflation was 1.4%. So it was really low.
Yeah.
And the Fed's projection for 2021 was 2.4%. So that's what they said. They said, look, it's low now, but it's going to get a bit higher. Don't freak out. It's going to get right into that sweet spot, 2 to 3%. It's going to be perfect. It's going to be a great year.
Okay.
That was the start of the year. Fast forward to March, which was the next meeting, inflation hit 2.5%. So it quickly, moved into the projection for the year. And the Fed said, you know what, it's at 2.5%, but we're still going to see 2.4% over the course of 2021. Holding strong, yep. Still, he was confident in that 2.4% number. Fast forward to June, we won't do every single month. In June, inflation had shot up to 5.2%. So now things are getting quite heated, right? Well above the 2.4% they originally projected. And the Fed came out and said, look, we were wrong. Well, he didn't really say this, but we were wrong. 2.4% is wrong. It's actually going to be 3.4%.
Yeah, getting closer.
So see, he's edging it up there. He's getting closer.
He's adjusted his price targets.
All right, then fast forward to September. So this is just 3 months ago. Remember, inflation was still around 5.2%. So it kind of flatlined for a little bit.
Yes,
and
that's right.
I think Powell was kind of getting confident, like, okay, this is the peak. Yes, I was getting nervous for a little while there, but this is it.
I think it was like 5.2 or 5.3 for like 3 or 4 months in a row.
It was, yeah. So it stayed around that for a little while. And the Fed said in September that 2021 is going to be 3.8%. So still increasing their expectation, but still were expecting, even in September, 3 months ago, that it would decline pretty substantially from September, down from 5.2 to 3.8. And, their projection in September, 3.8%, we know how wrong that was. I mean, 3 months later, we're at 6.8%, which is almost 100% wrong. Like,
You were very, very off the mark.
you're very, very wrong. So it's kind of crazy. And I think this helps bring into perspective how little we should emphasize what the Fed says about inflation in this kind of volatile environment. I know you're going to talk about the Fed's meeting in just a second, but just to stay on this kind of topic, I personally couldn't help but laugh when I saw that their latest projection for next year, so 2022, is 2.6%, which is it looks very familiar. The start of the start of this year was 2.4%. So are we going to see a repeat of that? I don't know, but I certainly don't trust the Fed's projections after seeing them be wrong every single month this year.
I think honestly, this is speaking to a larger point in finance, and that's that really don't trust any financial estimates. Don't trust analysts' estimates. Don't trust Jerome Powell's estimates, forecasts, that sort of thing, because these numbers, they just can't be accurately predicted. And even you can even take that one step further. When you're looking into a company and trying to put a valuation on it, don't even trust your own numbers. I think it's just a general rule in finance that you have to we have to, when we're doing our valuations, we have to try and model out into the future because that's just the way that we do it. That's just the way that it works. But I think it's important to realize while you're doing that you are trying to predict the future and no one can do that. So you have to always take even your own future projections with a grain of salt. And that's where the whole concept of margin of safety originates, is knowing that, okay, if we deem a fair value in 10 years to be $100. Well, how certain am I? Okay, I'm not actually that certain because I'm just playing a guessing game based on my own research. So I have to take a margin of safety to make it literally safer for me to make that investment, so that if I'm wrong, then I still likely won't be hurt on the downside. So I think that what we're talking about, yes, we're talking about kind of missed inflation estimates, but I think it speaks to a larger point in finance, which is just don't trust any sort of future estimates. Always take future estimates with a grain of salt.
Yeah, 100%. All right, do you want to take us through, where should we go? Do you want to talk about the Fed meeting that just
we'll keep rolling
happened?
on. So we've spoken about, so that was a good kind of spiel on how we've gotten to where we are with inflation. And we saw, it was only a couple of weeks ago that the Fed kind of came out and said, look, okay, we're retiring the word transitory.
You didn't get it. You didn't understand transitory.
Yeah, exactly. It was so funny. If you can't remember, he basically came out and said, look, it's not that this inflation, we're retiring the word because clearly you guys didn't understand what we meant when we said transitory.
Did you guys not get that?
It's
transitory means 6.8% inflation. It's very clear.
Yeah. Pretty much. So anyway, the Fed, sometimes with the podcast, we kind of just scrape through and get a bit of news. Sometimes we just miss a bit of news because we recorded on a Thursday. Right now, we're right in the middle. So it is currently the 16th. So that means that it's just, the 15th in the US is just finished. So the Fed is halfway through their meeting, I guess. And I actually wrote down what was I expecting from this meeting, because I was writing this story yesterday. So I just jotted down what do I think will happen. And I wrote down, I think there's definitely going to be an announcement about faster tapering of stimulus. I thought there was going to be no talk of a 2022 rate hike, but I thought that they were definitely going to be thinking about it. So I wasn't expecting them to actually say anything about it. Yeah. I thought they would just keep their mouth shut to just keep everything calm and then I thought that they were likely to admit that more inflation is coming. So then I woke up this morning and I had a look at this CNBC article to see what actually happened. And so far, the news that we have is that the Fed will be buying $60 billion of bonds each month starting in January. half the level prior to the November taper and 30 billion less than it had been buying in December. The Fed was tapering by 15 billion a month in November, doubled that in December, then will accelerate the reduction further come 2022. So it sounds as though, that sounds confusing to me. But I think they're going to wrap this thing up quite quickly. The article says, after that wraps up in late winter or early spring, the central bank expects to start raising rates, which were held steady at this week's meeting. Projections released Wednesday indicate that the Fed officials see as many as 3 rate hikes coming in 2022, with 2 in the following year and 2 more in 2024.
Yeah. And I mean, those, like the projections they give for the following year in 2024, just completely like let that leave your mind, because like if you remember at the start of the year, I think they were planning one rate hike next year. So like their projections beyond, the next few months of what they're going to do. And even that changes is just kind of useless. But I mean, even go back 2 months ago, they weren't planning on accelerating their tapering. So it's crazy. But I'm honestly surprised. I think they've ramped it up more than I expected. Honestly, I don't know. What do you think?
I mean, it had to happen. It just has to. Because I think what this indicates is that the Fed wants to raise rates ASAP. Yeah. But of course, you can't start raising rates if you're still doing stimulus. It just doesn't make any sense. No. So you have to stop the stimulus and then you have to start the rate hikes. But at the same time, they want to do that in a way that's as smooth as possible, just to cause the least amount of disruption and panic, I suppose. My perspective is that they were going to get this done as soon as possible next year, so that they could. Yeah. My opinion was that they were just going to wrap it up and then start rate hikes as soon as possible, maybe even like in the first half of next year, which kind of seems like that's on the right track. I think I was personally surprised. So I think they'll be finished with the purchases in March. And then they also said that, I think he was asked a question specifically about whether there would be a break between the tapering process and starting to hike rates. And he said, no, there wouldn't be a break. They would do them both in March. So I think March is almost a shoo-in, unless something else happens, which, I mean, look, surely they very well could be. It looks like they very much intend on doing the first rate hike in March. So, pretty soon. Isn't that interesting? Like, I think rewind 12 months and they were saying, we probably won't raise rates until 2024. And then it's now we think we'll do some in 2023. And then they were saying, no, we'll stay with 2023, but half of the people on the board were saying, we probably see some coming in 2022. And now they're just like, definitely 2022. There's just 0 point. I just kind of laugh when I see people, whether it's on CNBC and they're wearing suits, or it's on YouTube, when people listen to these projections and take them at face value, even though, you can look back at just the last few months and see that you couldn't have taken them at face value. It blows my mind. It really is. And I say this every time, but it's so true, especially now, that you just need to watch inflation and watch these changes as they happen. You can't predict what's going to happen. Next month, inflation could drop off a cliff. It could drop off a cliff the next month, and then again. And in March, they say, hey, we don't actually need to raise rates. That could very well happen. That's not off the table. We really don't know what's going to happen, or it could accelerate over the next couple of months. And they say, we actually have to end the tapering in Feb. We have to do 2 rate hikes in the next couple of months. Like that's very much what could happen. So nobody knows what's going to happen. And I think that's an interesting point that you raised. And it kind of reminds us that as, investors that look into individual businesses, you really don't want to make decisions based on the macro. it's good information to be up to speed on, so you can kind of, you know what inflation's doing, you know the challenges that are present in the macroeconomic environment, and you know that the Fed is currently keeping interest rates very low, and that means the borrowing. It's good to know all that sort of stuff. But when it comes to actually acting, if you're looking at a great business, I don't know, let's just say, I'm thinking about buying Berkshire Hathaway. But I'm not sure if I will, because even though, Berkshire looks great, and let's just say, sure, the current price is at a great margin of safety, I'm just nervous that the Fed's going to do something which will ruin my bet. Like, you just can't, you cannot go about it with that approach.
No.
I think just be aware of what's going on in the macro, but just focus on each individual business, and then make your decisions from there.
Yeah.
And then, sorry, just lastly, because we were talking about how Jerome Powell changed his inflation expectations over time. The committee sharply ratcheted up its inflation outlook for 2021, pushing it to 5.3% from 4.2% for all items, and 4.4% from 3.7%, excluding food and energy.
Are they for real?
For 2022, yeah, as you said before, the expectation is now 2.6%. So there you go.
How is inflation outlook for 2021 still 5.3%?
Yeah, it doesn't make any sense.
That is ridiculous. That is just... unless
surely
they know
that
something
means,
that I don't, but they've been wrong every other meeting. But
if it's currently at 6.8%, does that mean that they're expecting like a little bit of deflation in December? Like, I don't know. I don't get it.
I don't get that at all. I mean, this is going to be one of the biggest holiday periods for consumer prices ever. So yeah. I just can't imagine that the first Christmas after everyone has been in lockdown for so long. I mean, I guess there was one last year, but like this is the first time when everyone's out really and going to shops and that sort of thing. I just can't imagine that is a Christmas where prices either deflate or don't go up a lot. That is a period where prices will go through the roof.
Think about it like this. Just generally, we already have a demand supply problem. There's not enough supply. Yeah. And there's way too much demand. Forget about what time of year it is. But that's a big reason, like they're talking about the whole disruption in the supply chain. That's a big reason why we're seeing so much inflation. But if you get to the end, like you think about Apple, or you think about, I don't know, any of these companies that make electronics, gifts, toys, that sort of stuff, they always report the most sales in the Christmas period.
Yeah,
that's all. Like, they're so seasonal. You can look at their numbers through history. It's just like always the calendar Q4 is always the most the biggest quarter. So that's just another demand dump on top of what's already happening. So there's literally no way that it could go the other way. There's literally no way.
Are they trying to get it wrong? Like, I
don't know.
If we come around, I guess we'll be in like mid-January when we'll finally find out what 2021 was overall. If that is 5.3%, I will be shocked. Like, I will be shocked if it's 5.3%. I just can't imagine it being below 6. But look, we don't know what's going to happen. But God, I can't believe that's the projection. We're like, they're making this projection 15 days before the end of the year. Yeah. What's going to happen in 15 days?
Yeah, it's like if they're going to say like 5.3%, they may as well just say we think it's going to be 2%.
Yeah, exactly.
Right in line with our expectations.
I don't get I don't get it. I really don't get it. But look,
anyway,
who knows?
Here's what it is. So yeah, there you go. Yeah, I think we'll see. We'll probably just see more. The Fed will just be, I wouldn't be surprised if inflation goes up. The Fed will taper faster, raise rates sooner. That's just what's going to happen.
We've got some news out of your best friend Elon Musk. He's Time Person of the Year, ladies and gentlemen.
He is. Well done, yes, Elon. Yes,
good job, Elon.
Nice. To be fair. Yeah. I don't really know much about the Time Person of the Year or how it's judged or who gets it or whether it's just a PR marketing thing. But I don't know. I feel like if you're going to choose someone to be person of the year, Elon's not a bad choice.
Yeah, look, I know nothing. I agree. I didn't know much about this award. I've got a little bit of some fun facts about it that I'll share in a little bit.
Is it just like marketing? Is it just like...
I think it's just something. Yeah, it's just something the magazine does.
It doesn't actually mean anything. Does it get judged? Is it a panel of people that choose it?
I don't even know if it's... I don't know. I would imagine it's just a panel of...
it's just a magazine that... It's just who gets the front cover of the magazine, essentially. So it's not like it's actually... it's not like you won a Nobel Prize or something.
Yeah, exactly. It's just a magazine. No, but they so he won Time Magazine's Person of the Year. In it, they gave a pretty long description of some of the good things, some of the positive things about Elon Musk, some of the things that people kind of criticized him about. He did an interview. Essentially, overall it was very, very positive. Of course, they're giving him Time Person of the Year. They described him as a visionary who aspires to save the planet, and they said that he's a hybrid of Thomas Edison, P.T. Barnum, Andrew Carnegie, and Dr. Manhattan. So I don't know. I know a couple of those people. I don't know all of them.
No, I know a couple.
So Musk is the 95th person, I think, to be awarded the title. I don't know if that's actually true. I just looked up on Wikipedia and it said it had been running for 94 years. So I just assume it's probably 94 or 95, something like that.
Yeah.
It's been going on for almost a century, which is kind of crazy.
Wow.
So I thought we could take a look at some of the people that had been given the award in the past. Last year was, and sometimes it's one person, sometimes it's like a group. I think in 1975, I think it was like American Women was awarded it. So like sometimes they do a group, sometimes it's multiple people. So last year it was Kamala Harris and Joe Biden together. So that was kind of what happened last year. The year before was Greta Thunberg. And then Donald Trump was in 2016. So I was looking back, and I guess in years where it's a presidential election, the president just gets it. Seems, I looked back and it looked like Obama got it in 2012. So it kind of looks like that.
Yeah.
That's kind of what happens. The vice president got a call up last year though. Kamala Harris. I don't know how to pronounce her name, but very good. But couple of I was just scrolling through, and a couple of my favorites that I saw on this list, and these are not my favorites because these are good people, just because of how insane it is that these people are on this list. Hitler, 1938.
What the heck?
Was on there, so that didn't age well.
Person of the Year.
Yeah. So he'd made some trade deals with, I think, Austria. He had some kind of deal that he made.
Oh my gosh.
So and I think that, I don't know much about that time, but Germany during that time also hosted the Olympics, right? So it kind of puts in perspective how quickly things can change. But yeah, that's kind of crazy. Joseph Stalin won it twice. I think he's responsible for like 20 million deaths. So that's a couple of people on the list that probably shouldn't be there in hindsight. But
I don't know. Is it like is person of the year, if it is like a PR marketing, I don't know, marketing kind of thing, is person of the year like the good person of the year, or is it just kind of the person that has captured the most attention or
like the impact or something like that? I see.
Because if it was something like the person of the year, as in the person that's been most prominent in the year, or the person that's had the biggest impact, good or bad, then I guess you could have some villains on that list.
I think it's supposed
but then again,
to be good.
you probably wouldn't take that approach if you were Time Magazine.
No,
you probably don't want to say Time Magazine's person of the year is Adolf Hitler.
No, I don't think. I'm pretty sure that's not what was happening at the time. I think I think this was prior to all of that, but yeah, I don't know. It's I don't know much history of this. I probably should have done some research on this before I did this segment, but
bonkers.
It is just crazy. Like you look back at the list and there's some clearly great people on there, some people who you could take it or leave it, and then there's some people who really shouldn't be on that list. So it's it's kind of crazy. But of course, with that context in mind, there's always a mixed reaction to whoever gets the title. There's always some people who are like, how on earth can you have this person on the front of your magazine as person of the year? And that kind of reaction was kind of true this year as well. Not Naturally, there's a lot of people who were quite supportive of the decision. I think there's a lot of people who see Musk as just a person who is incredibly smart and trying his best and succeeding in trying to solve a lot of great problems around the world. There's also a lot of backlash. I think the Guardian's headline says it best. Their headline was naming Elon Musk Person of the Year is Time's worst choice ever, says critics. I don't know about worst choice
bonkers.
ever. If you look back at that list, I think I think he beats out a couple of the people I just mentioned. So I don't know about worst choice ever.
I think the Guardians, I would hazard a guess that the Guardians revenue comes from big auto, but why would he be the worst choice ever?
Yeah, I think there's a number of things. I mean, it always comes back to politics, really. All of these things,
doesn't it?
I mean, of course, I think Elon, he's obviously a billionaire, so that immediately puts him, on a particular political side when it comes to taxation and that sort of thing.
Yeah.
But he's also quite vocal on Twitter and in interviews about other things. I mean, he's had pretty strong stances in terms of like vaccine mandates, for example, which he's against, even though he's pro the vaccine and thinks it's a good idea for people to have. So I think as soon as whoever they put in that position, people are going to criticize them and say, hey, I don't like his politics on this side. And one of the funniest...
That's probably one issue.
Yeah, exactly. And I think I think the biggest thing was kind of the tax issue. A lot of people were like, wow, you've just put a billionaire on this position. Why is he not paying more taxes? And I think Elizabeth Warren's tweet against or retweet of the article and then Musk's response to it is just the most funniest. This is the funniest thing I've seen in quite a while.
What did she say?
So she retweeted the article where he won and she said, let's change the rigged tax code so the person of the year will actually pay taxes and stop freeloading off everyone else.
Oh my God.
And,
gee, this is why I hate politics. This is why I hate politics. This is really getting me riled up now.
Yeah, so and Musk responded with a series of tweets and it's just beautiful. The first one was, and if you opened your eyes for 2 seconds, you would realize I will pay more taxes than any American in history this year. He then said, don't spend it all at once. Or wait, you already did. He goes on to say, you remind me of when I was a kid and my friend's angry mum would just randomly yell at everyone for no reason. He then goes, don't call the manager on me, Senator Karen.
Oh my God.
And then the final one was just the nail in the coffin. He goes, stop projecting. And then he shared an article of when Elizabeth Warren a few years ago lied about being Native American during the election cycle to gain sympathy, which was...
oh my God.
Which is, that's it's some comeback from Musk.
I hate Paul. I'm glad that he stood up for himself. For those that don't know, Elon Musk gets accused of like paying no tax. Any income that he generates, he pays 53% of it to the tax man. 53%.
Yeah, but isn't he paying like $10 billion this year or something insane like that?
I thought it was more 50. I think it was like more like 15 billion. Anyway, yeah. I'm not exactly sure, but yeah, multiple billions of dollars. Like,
yeah. I mean,
any income that he draws, if he sells his stock, if options, all that sort of stuff, he's going to pay tax. That he cannot realize his wealth and not pay tax.
Yeah, and I think that's really where the argument lies. And look, I mean, I think we have, everyone has an opinion on this, and some people's it's a very popular opinion that if you look at how much tax Musk pays and other billionaires, for example, or how much tax they pay as a percentage of their wealth, if you're including their assets, it's extremely small. And
to be tiny.
And some people look at that, and at the same time, if you have a lot of assets, you can use those assets to get loans against those assets, and you don't pay tax on loans. So, that's kind of a loophole people will look to say, hey, this is a way that people with lots of assets can pay extremely low income tax as a percentage of their wealth, not as a percentage of their actual income, their realized gains and that sort of thing, because that percentage is insanely high. But that's the perspective. I certainly I don't think I align with that, but yeah, I mean, regardless of what you think, I think Musk's response here is it's pretty good.
Yeah.
Don't spend it all at once.
Yeah. Did you see there's this, he dug up there was this video of Elizabeth Warren just like getting off of a private jet.
No.
And just like just landing on a private jet, walking out. And I can't remember what the caption was. Oh, I want to find it. But Elon Musk just dug it up by just commenting on that video. Interesting.
That's pretty funny. Oh, yeah. So there you go.
But I mean, yeah. What are at least this is my perspective. This is my opinion. So you can agree with it or disagree with it. Sure, Elon Musk, he has a lot of money. Sure, he flies around in a private jet. But the way I see it is that he works 7 days a week, and everything that he is doing is going to somehow benefit humanity. To him, I say, good work, Elon. Like that, for most politicians, they'll fly around from state to state in a private jet, and they'll shout at other people. Two politicians will fly in on a private jet. They'll go and have a debate. They'll shout at each other. They'll call each other names, and nothing will get done.
I don't know if you can call him a freeloader. I think he's probably the furthest thing from a freeloader.
Yeah,
that's just not accurate at all. If you want to,
but it's just so interesting how this has become a political tactic. It's not like I'm sure most of these people are fully aware that what they're spitting out is complete BS. But it's just the fact that so many ignorant or less educated people on this topic are just so they cling on to, they're so in belief that billionaires are bad, so naturally as a political party they have to follow that line. They have to capture the vote of those people by saying, this is broken, billionaires bad, Elon Musk villain, blah blah blah. But anyway,
it's
that's my opinion.
Yeah, it's just a consequence.
Feel free to disagree.
I think we were talking about this last week. It's just really a consequence of or maybe I was talking about it in a video, but it's really a consequence of this growing wealth inequality because assets have done so well. You have, people getting stacked up at the bottom that are looking up at people whose wealth doubled last year, while everyone else, a lot of people lost their jobs, and they're just like, looking for something to yell at.
Yeah, I can't remember who was it. Or was it? Did I hear this from? Maybe it was an Elon tweet or something. But it's like the US has, I think, $29 trillion of debt. It's like if you took every single cent from every single billionaire in the US, you don't even put a dent in that debt. So it's like, it's like, you can call most of the wealth is in the top 1%, but it's like still in the grand scheme of things, and it's just, I don't know, man. I don't know. Anyway.
Elon Musk, Person of the Year.
Person of the
Year.
There we
go. Congratulations.
Well done, Elon
Musk. I like to see him up there. Good man. Keep it up.
Good man.
How's SpaceX going? Is it still still got enough?
Oh yes, it's still surviving. Nah, to be honest, I think Elon was just a bit angry.
Oh, okay.
At the lack of progress of the Raptor engine development, so I think he just spat some fear of bankruptcy stuff out there to try and kick people into gear.
Yeah. Okay. Right.
That seems to be what actually happened. But I mean, he's not wrong. If they can't develop their engines, then it's only a matter of time before they go bankrupt because they won't be flying.
That's true.
So he isn't wrong in a sense. But anyway. All right. Should we just quickly finish off maybe talking about this debt ceiling stuff?
Yeah. Take us through it.
Okay. Debt ceiling. So, I mean, we've already covered this to death, but there's just like a slow stream of updates here. So we were talking about last week, 14 Republicans joined every Democrat to allow a one-time vote to lift the debt ceiling with a simple majority instead of a supermajority. That's what we were talking about last week. Or was it the week before? Probably last week. Now, congressional Democrats passed a debt ceiling increase and sent it to President Joe Biden's desk early Wednesday. The deadline that Treasury Secretary Janet Yellen warned could mark the start of the first ever US default. The president is expected to sign the borrowing limit hike just hours before the Treasury Department forecasts it would exhaust its tools to pay the government's bills, an outcome that could upend the US economy. The Democratic-held Senate and House passed the debt ceiling increase with only one Republican vote. The Senate approved the measure in a 50-49 party line vote late Tuesday afternoon. The House followed early Wednesday, passing it by a 221-209 margin, as only one GOP representative joined every Democrat. Once signed by Biden, the resolution would increase the debt ceiling by $2.5 trillion. So it says here on Tuesday, Senate Majority Leader Chuck Schumer said the measure will raise the borrowing limit, quote, to a level. How do you say that word? Commensurate. I don't know.
Commensurate. I don't know.
With funding necessary to get into 2023.
Right.
Yeah, there you go.
Okay.
So it's all done.
They got it done. A few hours to spare as well, which is plenty of time. No stress.
Yeah, okay.
Send it over to him to sign in the morning that they're going to default.
Yeah, fine. Joe Biden, just please don't be late from your breakfast, because we've only got 45 minutes to sign this bill to get us to raise the debt ceiling. But as I wrote down here, as you would typically say, Hamish, they kicked the can down the road.
I just like to imagine, like, a few days later, it's like Saturday or Sunday or something, and the government's just like trying to like pay for something and it just doesn't go through. And they're like, Joe, did you sign that? Did you sign that debt ceiling increase? And he's like, what debt ceiling increase?
Biden's at like Target trying to buy some like shirts or something.
Yeah.
Puts up his credit card and it says, credit card declined.
Yeah, that's how it works, right? Like they just all have credit cards, and when they need to, I think that's how it works. And then they just, if they swipe and the debt ceiling hasn't passed, then it just says Fed defaults on the little.
Yeah, it just says US government insufficient funds.
Yeah, insufficient funds. Yeah, try another card. Try again.
That's hilarious.
No, but I think unsurprising that they ended up not defaulting. I think that was, that was really never.
I don't think it was a realistic possibility.
No. It made a good headline though for a lot of these news outlets. They probably got a lot of clicks. We clicked on these articles quite frequently over the past.
Yeah, we've spoken about them. Made a podcast about them.
Yeah, our entire podcast has basically been debt ceiling and inflation. And Jerome Powell. So, yeah.
It's really what's been happening at the moment. It's been...
Yeah, there really has been. I mean, earlier in the year, it was really dead in terms of what was going on in the markets. And then, it's just been a lot of debt-related news. I mean, Evergrande, we didn't speak about that today, but they actually defaulted, I think, since the last podcast. So that's something we didn't even get to talk about today. But
we'll have to talk about that next week.
I think so. I think, there's a lot of updates coming out of that. There's obviously flow-on effect into other property developers that are now collapsing as well. So next week will be a nice kind of, I think, almost 2 weeks since they defaulted. So there'll be
we'll have more news.
There'll be a nice kind of, I can talk a little bit about the timeline of what's happened over that period and what to expect. But there's been that, and then there's, inflation and government debt ceiling. It's just a lot of debt and inflation and a lot of macro issues.
Yeah, it has been a lot of macro stuff.
Yeah.
But it makes sense, I guess, with all that's been happening.
Yeah. All right.
there you go.
Is that all we had to talk? Do we have any other stories to go through, or should we get into some Q&A?
I could quickly cover this Toyota thing. I don't have to go through it in depth.
What's going on?
The article is basically that Toyota's going to invest $35 billion into battery-powered electric vehicles and roll out 30 models by 2030. Whoa. Yeah. Although, for those that have been following the EV space, most of us know that really what this article, the headline should be, is Toyota is finally unable to escape announcing an eventual transition to battery-powered electric vehicles, despite management's best efforts to avoid doing so. That's really funny. Like Toyota.
Are they really lagging?
I don't get it. They're so bad. They are so bad. But this is the thing. They were the leader in hybrids.
That's right.
Back when, before battery electric vehicles really, before anyone was making any battery electric vehicles, they were leading the charge in hybrids. But they really stopped. They just did not chase battery electric vehicles in the slightest. They are literally being dragged kicking and screaming into, like, I wish that the CEO of Toyota is probably looking at this announcement and going, man, I wish I didn't have to do that.
Yeah.
Which is pretty annoying. It says here, Toyota, one of the largest automakers, is planning to invest 4 trillion yen or $35 billion to build a full lineup of 30 battery-powered electric vehicles by 2030. It aims to also increase global sales of battery electric vehicles by 3.5 million units a year by the end of the decade, CEO Akio Toyoda said Tuesday. And by the way, that sounds like a lot of vehicles. We aim to increase 3.5 million units a year, battery electric vehicles per year by 2030. That's not a lot. For example, Tesla is aiming for 20 million units per year by 2030. And in terms of their operational size at the moment, they are very much smaller than Toyota. I know we talk about Tesla having a massive market cap and that sort of thing, but when you just look at how, like, their size operationally and what vehicles they can produce, like last year I think they made 500,000 500,000 vehicles, and they're estimating that by 2030 they're going to do 20 million units. And Toyota's I think Toyota, they do over 10.
It's over 10.
10 million units a year or something like that.
Toyota.
Yeah. But Toyota and Volkswagen are like 1 and 2 in terms of car units produced per year. They're the big players. Yeah. So saying for Toyota to say, look, by 2030 we want to make 3.5 million units a year, it's nothing. It's like the weakest possible goal you could have.
Yeah. Well, yeah. So they do 10 million. It is 10 million that they did last year. So yeah. So they're still expecting, I guess, to be doing a lot less than even half of their vehicle sales in electric, unless they're expecting their business to fall off. Then they come out, we expect to be completely electric by 2030, and we'll be doing about 3.5 million vehicles a year, about a 70% drop from where we are now, we anticipate.
And normally you'd expect like the quotes from the CEO alongside a story like this to be like, yeah, we believe that electric cars are the future and we're pushing as hard as we can and blah, blah, blah. We love the environment. I think the quote from the CEO was, in this diversified and uncharted era, it is important to flexibly change the types and quantities of products produced while keeping an eye on the market trends. We believe that quickly adapting to changes in the future is more important than trying to predict the future, which is nothing but uncertain. So it's basically saying, we're not going to try and predict the future. If people start to switch more to electric vehicles, then we'll probably just follow that trend. But as long as it's profitable for us,
Yeah, and I think that right there is why when there's big changes in industries, usually the legacy businesses don't make the transition. They just die. And then some new business comes through, because when there's a big change, there's just a huge reluctancy to give up what they have now, which may be a nice profitable engine in exchange for something new. I mean, I don't know if this is going to happen. This is just a random example that I just thought of just then. But if you think of Coca-Cola, for example, they've had huge success over 130 years of selling soft drinks. Let's just say, for example, I don't know if this is true, but let's just say people no longer want to drink soft drinks because people want to be more health conscious and people are moving towards like seltzers and drinks like that, for example. Like Coca-Cola could try and move, substantially into that industry, but they also have to think about, they're huge, what they're giving up in what they have right now. I don't know if that is just a random example. Like,
no,
if there's a big shift, often it'll be this new business that doesn't exist that says, hey, we can just go all in on this new innovation. We don't even have to think about the past because we have nothing to lose. We're not giving up our past business. And we can just go full blast into the new business. I guess a better example would be the digital advertising landscape at the moment, or the advertising landscape, and the reluctancy of legacy media businesses to adapt and change into the models that like Facebook and Google are using. So, yeah,
exactly. But I'm glad that this article does kind of call them out in a way. It says here, despite being one of the pioneers of hybrid models, Toyota has been relatively slow in its push towards battery-only electric vehicles compared to some of its global competitors. Last month at the UN Climate Conference in Scotland, the Japanese automaker declined to join a group of 6 major car makers, including Volvo and Mercedes-Benz, to sign a declaration to phase out fossil fuels by 2040. So
2040. Whoa.
Yeah, it's a long way away. It's like, come on, that's like the easiest thing you could sign ever. That's like Australia's net zero by 2050. It's like, oh my gosh, come on, you can't it's the easiest thing to commit to ever. But yeah, they are literally being dragged kicking and screaming into this battery electric vehicle revolution. So get up to speed, Toyota. I mean, but another point that was interesting that Elon Musk kind of commented on one of these Twitter threads is that just because all these car makers are saying they're going to invest a certain amount of money into the industry doesn't actually mean that they will, that they will have great success and that they will start producing heaps of cars. I mean, it makes sense. It comes down to, how well can they use that capital to be able to make profitable. Like at the moment, there's very few electric vehicles that are made in the world that are actually profitable programs.
Yeah, I mean, there's obviously some crossover between different types of vehicles, but you would imagine that, I think it's true that Tesla has the most experience in creating electric vehicles as it is right now. Even though there's vehicle makers that have been around for much longer, there's aspects of electric vehicles that are not, it's not transferable from the old ways of making cars to new cars. There's new innovations that need to be made, and Tesla is leading the way by a long way in that space.
Yeah. Yeah, so there you go. Suck it, Toyota. Cop it.
And in conclusion,
yeah. Oh dear, man. Jeez. All right, let's do some Q&A questions.
Let's do it. I'll pose the first one to you. I'm having trouble understanding how companies are benefiting from buybacks in certain situations. Buybacks are often said to be a great capital allocation decision, but wouldn't it be better from the perspective of a company to invest that money in growth somehow?
Absolutely. Yes, it would be. I would very much prefer it if companies that are just gushing cash, I really just want them to take that cash and put it towards growth ventures. This is my gripe with Apple, for example, is that they make so much money and that gives them such an amazing position of power within the technology industry. I'm like, just take this great amount of money that you've got and do a Steve Jobs and make something that is just revolutionary and makes us go, wow. That's what I want. I want that for all businesses, but there are some businesses that once they get to a certain size, they make so much money and their growth avenues start to deteriorate. So once they have kind of exhausted their growth avenues, then they look to do things like take care of their shareholders through paying dividends or doing big buybacks. Because, like I said, personally, I just want them to find things to grow the business, to make new products for consumers, to do all that sort of stuff. But I'm trying to think of an example. I don't know, maybe there's like an energy company or like a telco where they've just kind of gotten to a size where, they're up to speed. They've built out their network. They offer a good product and service, and now they just make a whole lot of money. They don't have maybe all that much room for innovation now, so they just give their money back to their shareholders through dividends or buybacks. So, I mean, as a shareholder, it makes you happy. I mean, you still definitely benefit. Obviously, dividends are just giving you money for holding the shares, which is like, all right, I'll take it. It forms part of my return. Buybacks help as well. They return capital to shareholders, but Yeah, in a perfect world, I always I wish companies could find growth avenues. Sometimes it's just not the way it works.
Yeah. I think it entirely kind of comes down to what return on investment can the company get on that money. And obviously at first you would want them to invest in their business, because that's a quick way for them to, well, in growing businesses, it's a way for them to compound their profits and grow it into larger profits that can then be reinvested again. But buybacks can be good. I mean, they can be good if the stock, this is what Buffett says. I mean, if the stock is undervalued, you can think of it the same way as if you're buying the stock, right? If you owned the entire business, think of it from that perspective, then it's very similar if you were just adding more stock to it, you personally, or it's the company that you own using the money in the bank account to purchase more stock. You want the stock to be cheap. And if the stock is cheap, then you're getting a good value, because the exchange that you're making is lower cash for a higher percentage ownership, regardless of whether you're buying the stock with money out of your bank account or the company's bank account. In both situations, you have less money. One is in the company and one is you personally, but there's less money and larger percentage ownership. And the question is that relationship better than internal investment opportunities? Sometimes it is, sometimes it isn't. And, whether a management team can figure that out is important. And when they do, then, and if they can, then buybacks can make sense. And then kind of the last option, I think, is dividends, because there's no compounding in that at all. You obviously have to take that money and find a new investment opportunity. You need to compound it yourself. So that's kind of the line of thinking for that.
Yeah, no, that's a good explanation of the technical side of how do you know whether you want them to do buybacks, or how do you know whether you want them to keep their money? Like high return invested capital, keep the money, guys. Just you guys doing great with it. Don't give it to me. I can't do what you guys are doing with it. Just keep doing it yourself.
Yep.
So yeah. All right, last question. All right. I have a question about active investing. How much of my portfolio should I have in a certain stock at once?
That's a good question. I don't think there's any kind of single answer. There's no
there's no right or wrong. It's actually set in stone.
It's actually 17.346%. No, there's nothing.
The hotter formula.
Yes, says. Exactly right. No, I think it depends on a couple of things. I think it depends on your approach. I mean, if you're a passive investor, then that's kind of allocated for you. You just go for the index, and it'll be a very, very small percentage in each business ultimately. Yeah. If you broke the index out into individual businesses. But your question is about active investing. I just realized the start of that question. But that's of course what you're asking about. I think it depends on your confidence on that individual business, with a limiting kind of principle that there should be some kind of upper limit where you would not be comfortable having that much in an individual business. So I'll give you an example. For me, I think it's probably about 15% is my upper limit. But that doesn't mean I put 15% in every stock that I invest in. My level of confidence and how cheap that stock gets also dictates the difference between it being 0% and 15%, if that makes sense. So something that's really cheap, I'm extremely confident in, something I've researched, an industry I understand very well, I've researched it for multiple years, that will be a business that will reflect a 15%, as much as 15% in my portfolio. Other businesses, maybe it's my first investment in that company, maybe it's not that cheap, it's just getting there, maybe that's a couple of percent. So that's kind of how I think about it, but I don't have any kind of set fixed percentage philosophy, I don't think, except for the upper limit, which is where all I do is I go through the mental process of thinking, if a stock went to zero, how much of my portfolio would I be okay with? Obviously you don't want to see that, but if it did happen, I be okay if my portfolio went down 15% because one stock went to zero? That's how I kind of think about it.
Yeah, that makes total sense. I'd probably be in line with you. Maybe I probably wouldn't mind having 4 stocks in my portfolio, so 25% in each. But I think your approach, what you just described there, of thinking, reverse engineering it, say I just have missed something about this business. The management team are crooks and they just make out like really top blokes, and the stock just goes to zero because it's a complete scam. Right.
150 billion valuation.
Yeah, and it just comes back down to earth. Yeah. No, I think that makes sense. Like you'd be comfortable. Like you wouldn't like it, but it wouldn't be the end of the world if you lost 15%. And, chances are you'd recover from that in, the long term by all of your other businesses performing pretty well. So yeah, I think that's a good way of looking at it as well. There's no right or wrong answer. It's just what are you comfortable with? I mean, Warren Buffett, if you just said, Warren, just invest in insurance businesses for the rest of your life, start again, but invest in insurance businesses, I'm sure he wouldn't even care if he put 100% of his portfolio in one particular company just because he knows that industry so well.
Well, yeah, he had 70% in American Express at one point.
Did he? Yeah.
So he's not really had a philosophy either. It's really been down to he was very strong on his conviction on that stock, and that's what it reflected in the portfolio. And it didn't stay like that for a long time, but that's kind of an idea of if you were Warren Buffett and you were so confident because that's the person you are, you're that good, then that's where it goes. I would not feel comfortable putting 70% in the stock.
Even now, Buffett's got 43% in Apple.
Yeah, there you go.
So, that's risen because obviously Apple's stock has risen, but still, it's still 43% of his portfolio.
True.
So yeah, he's happy to make big bets, but it's what you feel comfortable with is the right answer.
Yeah.
All right, cool.
Thanks.
Well, let's wrap things up.
Yeah, thanks everyone for tuning in. As always, quick reminder, we may be doing that Q&A special in a couple of weeks' time. So if you have questions, head over to the YouTube version of the podcast and just click on the latest episode and leave your questions as comments. And we'll take as many of those as possible and cram them into a special episode over New Year's. But thanks everybody for tuning in. Thanks Sharesight for sponsoring. Head over to sharesight.com/young investors and get 4 months off 4 months off a yearly subscription if you sign up. Wow, I'm choking over my words at the end of this. So
you're getting a bit tired.
So check that out if you're interested. Thanks, Brandon, for joining me as always.
Oh, gee.
Good luck over the next 4 days.
Yeah, thanks, mate. You too.
And we'll see you guys next week.
See you later.